Peace, family. So I've been getting a ton of requests of people asking me, what is the difference between statement dates and due dates on credit cards, on their auto loans, on their mortgages? It's confusing. I don't understand it. What do I do? When do I pay my bill? When is it late? All of those things. But before we even get into that, people also often ask me, by paying my credit card bills early, does that help my score? By carrying a balance, does that help my score? So all of that plays into the part of statement dates and due dates. Now, first of all, let me tell you, paying your credit card bill early does not help your credit score. Let me say that again. Paying your credit card bills early do not help your credit score. Now, check this out. There is a disclaimer or a caveat, I can kind of say. On the business side, paying your credit card bills or just your bills, period, on the business side can help your credit score with the business because they have they call it like a predictable meter or something. I don't really know the industry terminology or technical terminology, but they actually gauge you based upon how soon you pay your bill close to the due date of the actual bill. So let's say on a business credit card, you have from like 1 to 10 days early. And these are just examples, but it actually does work like this. Then you have from 11 to 25 days early. Okay. But then once you get to the actual due date on the business credit card, then it goes from 1 day to 30 days late, which means having on the business side with a business credit card or a line of credit or whatever type of credit you have on the business side, if you're 1 day late, it may not show up as a late payment, but it will actually affect your credit score on the business side. Now, the reason that's important because this still ties in to statement dates and due dates. So on the business side, and I wanted to touch on that first, because I'm going to go into the depths of the difference between a statement date and a due date. On the business side, if you are late 1 day, yes, it may not count against you as a late payment, but it does hurt your overall credit score because everything that they look at when they're gauging to decide if they want to give you access to credit, it's all based upon a risk factor. And whenever you're late within this 1 to 30 days, the risk factor can increase of them actually minimizing them wanting to give you access to more credit. And then you have from 31 days to 60 days and so forth and so on. Now, the good thing about business credit cards is when you call them to actually pay the payment, even if it is late, let's say it goes past the 30-day mark and they report a late payment, the good thing about business credit is that usually they're more apt to working with you and actually removing it. So you may say, you know what? I got caught up in work. I want to make this payment, pay it in full or whatever the case is. Would you guys be willing to reverse that late payment? And you'll be surprised at how, generous they are when it comes to business credit cards of them wanting to remove or reverse that late payment. So just a little bit of, game for all my people who are out there who have credit cards with their business. Now, to the meat and potatoes of the statement dates. Now, you have what's called your statement date. And then your due date. Now, what is the difference? Now, as I mentioned again, sometimes people are asking, paying my bills early, does that help? No, it does not help your score. Now, another thing when it comes to your credit cards or your auto loans or whatever the case may be, does carrying a balance or paying it in full help more? Now, this is what I will say. Keeping your credit cards at zero balance all the time can hurt you, but that's when you never use the card. Now, if you use it and pay it off and keep a zero balance, that's fine. See, when they tell you to keep making monthly payments or you want to just make monthly payments on $1,000 charge, that's their way of them saying, hey, we want to be able to eat off the interest because that's how banks make money. And you can't knock them. They're in business to make money. That's why they want to be able to loan you credit so that they can make money. But I'm going to teach you the nuances of how to play their game. And when you learn the rules and how to play the game, you can play it a little bit more effective And it can prevent you from actually harming your credit score, because sometimes people don't know how to play the game when it comes to statement dates and the due dates. So again, paying the credit cards early doesn't help your credit score, and keeping a balance or paying it off in full, it really doesn't matter. Now, making monthly payments on the card, whether you pay it off in full or over time, that is going to help you to develop what is called payment history. So now the payment history is beneficial for you because it is 35% of what makes up your credit score. This is why a lot of times when you pay off a credit card and that's the only thing you have reporting, your score can actually drop. That's right, paying a credit card off, and let's say that is the only thing on your credit report, it can actually drop your score. It actually works the exact same way as if, let's say, all you have is an auto loan and nothing else reporting on your credit report. Once you pay off that auto loan, your score is going to drop because essentially what makes up 35% of your score is no longer reporting. So again, these are tying into essentially what I want to talk to you about here today, because these are all things that usually get people credit in shambles because we don't know enough about statement dates, due dates, and all of these different things. So when it comes to statement dates, it may also be commonly referred to as a closing date. Essentially, the statement date or closing date is typically the day that they use to calculate the interest as well as the balance on that actual account. Now, again, the statement date and closing date, it's the same terminology. And this is the date that is used to calculate the interest and payment or balance of the actual account. And this is what they use to determine when you actually have a due date, to determine how much you're going to owe on that actual account. Now, the reason this is important to know is because when you are actually paying the card off before the actual due date, it can help you to mitigate your interest payment or the length that you'll have to actually pay on it, because you can cut into the total interest of that actual credit card. Now, one of the ways to ensure that you can do that, because all banks have their different guidelines, is you want to pay above the minimum payment. So let's say you have a $15 credit card payment. If you send at least $45, you're going to actually cut into the interest. Now, paying on that card prior to the due date or closing date doesn't make that much of a difference, but paying above the minimum balance does. Now, also keep in mind, the statement dates or the closing dates usually run a window of anywhere between 28 to 31 days. Okay, 28 to 31 days. The reason that is important to know is because typically the closing date is about 21 days before the actual due date. The closing date usually is about 21 days before the due date. Now, here's another thing to understand. When it comes to the due date, and I'll go into what the actual due date is, typically about a week after the due date, and I'll write this on another sheet. So you have your due date. Okay. Now, typically the due date is the day the actual bill is due. The due date is the day the actual bill is due. So let's say you have, your calendar, you have your days of the week or whatever. Now you have a Visa card. Let's say you have a $1,000 balance, and let's just say for whatever your payment is $25 a month. Okay. Now your due date may be the 23rd of the month, which means you have to pay this $25 by the 23rd of the month. Now, once that $25 is paid, typically what happens is about a week after that, they will submit that information to the credit bureaus. And which is interesting, and nobody actually really knows the calculation or formulas of how this works with the credit bureaus. You have your statement date and closing date, which is the date that they use to calculate your balance as well as the interest. You have your due date as far as when your actual bill is due. And then typically they have a date where they actually send that information to the credit bureaus to update. And the reason that's important to know, because that can affect your credit utilization. That can affect your credit usage. Now, we all know that the credit usage makes up 30% of the credit score. Why is that important to know? This is the second largest component of what makes up your credit score. So you want to know the difference in the due dates and the statement dates. You want to know how much you can pay towards it. If you can pay above the actual, minimum payment, you're going to mitigate your interest on that actual loan, that credit card, that line of credit, that auto loan, whatever it is that you're paying towards. Okay. Now, a couple other things to know about the due date. Sometimes people, we understand life happens. So going back to the example, your due date is on the 23rd. Now, if you are 1 day late, it doesn't necessarily mean they're going to report a late payment, because what happens is that all credit cards have what are called grace periods. Okay. The grace period can vary depending on the creditor. Some banks have a 10-day grace period. Some have a 15-day grace period. Some have a 28-day grace period. Some may have 30. Every single creditor is different. So what I actually always recommend everyone to do is to pick up the phone, contact your creditors, because you may have more than one, and you want to ask them, what is the grace period for the due date on all of my cards, or all of my lines of credit, or on my actual loan, my mortgage, my student loan, whatever it is that is reporting on your credit report. The reason that is important to know is because life can happen. You'd be surprised how many times people have just randomly forgot because life happened. You're dealing with kids, you're dealing with family, you're dealing with work, you're dealing with life. And sometimes you just may forget to make that payment, especially if you're not set up on auto pay. And so if you forget that payment, let's say you're 3 days behind, you will already know, oh, let me go ahead and submit this payment. So this way I don't incur a late payment. Because when you get a late payment after the actual closing date and the due date, their interest can actually increase. So you will actually end up paying a penalty once it goes past that actual due date or the grace period of that due date. Now, every single creditor is going to be different. You want to contact your creditor and find out what their actual terms and conditions are past the closing date, the due dates, the grace period, etc. Now, here's another thing to understand. There are actually some banks, and more, I actually see this more often with auto loans, depending on who the auto loan issuer is. I've actually seen a grace period be 1 day. I had a client who had a late payment on an auto loan for 1 day, was late 1 day, and they actually sent out, a late payment notification. So you want to know this. And now we can get up in arms and get upset and say, hey, how can they do that? Because it's their money. But if we don't get the actual information, if we don't get, the actual grace periods for each one of the accounts, we would never know. But as they say, when you know better, you can do better. So what you want to do is contact all of your creditors, find out when's the actual due date, when's the actual statement date, what is the grace period, because all of those things can play a role in determining whether your score increases, whether your score drops, whether you get a late payment, whether you don't get a late payment. Because here's the thing. I talked about late payments and how on the business side, it's easily to overturn, or they're more willing to work with you. On the personal side, it's a lot more difficult to get those late payments removed because you don't understand the due date and the closing date and the grace period. And you can't call up to the bank and say, hey, I didn't know any better. They don't care about that, because guess what? On that agreement that you sign, there's little bitty words in all contracts that none of us ever read. We never have an attorney review it, that pretty much says whatever we want to do with that line of credit of this money that we're lending you, we have the right to do it. We can close your account. We can lower your credit limits. We can shut your account off without giving you any notice or any notification. And I say that because people often say, well, they cut my credit limit in half. Can they do that? Yes, they can. It was in a small print of that contract. And for those who are in the world of law, there's a joke that says, in contracts, the big print giveth and the small print taketh away. So in the small print that took away half of your line of credit, that's because none of us ever read the contract. And usually all of this terminology is also in this contract. They talk about the grace period. They talk about the statement date and the due date and the interest rates and all of those things. Now, another thing to know, if you go past the due date and incur a late payment, even if it's within the grace period, they also can increase your APR, which is your annual percentage rate. Your interest rate can actually increase, typically only on credit cards, because when you actually have what's called secured debt, which could be a mortgage, an auto loan, your student loans, which I don't know how they secure that, but typically the interest rate is fixed. But anything that is unsecured, this is why we have to know the difference between secured and unsecured debt. When the debt or the credit is actually unsecured, that means credit cards, the department store cards, anything with a revolving balance, the interest rate can increase by not meeting the due dates. And this is how they get you. Now, another reason I want you to know this information is because typically when you're dealing with unsecured credit, the money is going to be generally a little bit more expensive. And that is because if you get a late payment because you go past the due date, and let's say for whatever reason, you just say, you know what, forget it. And this is why I want you to know the grace periods, because I've actually talked to people who they'll be one day late and they say, well, it's already late, I might as well not pay it. No, you may be within a grace period and still can save that line of credit from going delinquent. And so the reason you want to know this information is because by getting that late payment, not only will your interest rate increase, but you also are going to incur additional fees. This is another thing that a lot of people aren't aware of. But now here's the good thing about understanding all of this information. If you get back into good graces with that creditor, with that bank, you can actually renegotiate the interest rate. Now, even if you don't get a late payment, I always recommend you renegotiate your interest rate. You can renegotiate your interest rates on your credit cards. Again, the banks want to typically do long-term business with you. But if we don't get this information, if we don't know how to play the game with the due dates, the statement dates, the grace periods, and all of these things, it makes it harder for us to be competent when we're dealing with banks, when we're dealing with the creditors, when we're dealing with just the game of credit. Because see, all of these things tie into what calculates our credit score. Understanding the due dates, the closing dates, because here's the thing. By missing the grace period, as we talked about, is going to incur what's called a late payment. Now, we already know a late payment can drop a score 50 to 150 points. Again, that's part of your payment history, as we talked about. And that's 35% of your score. And then if you aren't paying, the amount that they saying that you need to pay, or if your credit usage is too high, or you only want to pay the minimum payment forever, for one, you're going to pay a ton of money in interest. But then two, now you're up against the credit usage, which we know, as I mentioned earlier, is 30% of your score. So these two components, by not effectively understanding how statement dates and due dates work, is going to affect 65% of what makes up your credit score. The two largest components that make up your score, which is why it's vitally important to understand statement dates and due dates. Now, I know I keep harping on this, but this is because I've seen so many credit reports, get a decrease in their credit score just because they don't understand the two. Now, here's one piece of advice I'm going to give you. Pick up the phone and just contact the creditor. And I say that jokingly because we get so scared to call the creditors. We get so scared to call and ask questions. What can they do? Beat you up over the phone? So it's just about asking questions. It's just about being armed with the proper ammunition so that you feel more confident. And when you have confidence, you are more competent. When you're contacting these banks, when you're contacting these creditors, you'll know how to go in and negotiate your interest rate. You'll know how to go in and even work on trying to remove that late payment if you do get a late payment. So again, I'm just want to be able to provide you this information as mentioned, we get a ton of people reaching out to us, asking us the difference. What is the difference between a statement date, a due date, a closing date? What do I do if I get a late payment? Again, you have all credit cards, all creditors, your auto loan, they all have what are called grace periods. So what I want each and every last one of you who's watching this video to do, stop whatever it is you're doing right now, pull your credit report, go and look at all of the creditors who you're paying. Yes, it's going to take you some time, especially some of the credit reports I've seen where they have 20, 30, 40, 50 accounts on there. Now they're all positive, but yes, it could take some time. Contact your creditor, and you actually want to write this down. See, you should be able to go through your credit report like a business and structure it and become more organized. So again, you want to pick up the phone, contact all your creditors and find out, hey, what is my due date? Hey, what is my statement date? What is the grace period on all of these different accounts? Now, one other strategy I want to give you in relation to due dates and statement dates. Now, people often also ask, try saying that 3 times, how can I pay my account off early without me paying a bunch in interest? So typically, going back to this scenario, your due date is the 23rd. Now, let's say your payment is $300 a month. Now, you pay your $300 on the 23rd, okay? And of course, they're going to apply whatever amount to the principal and whatever amount to the actual interest. You can actually cut the amount down quicker, and there's 2 ways you can do this. By paying an additional payment after the actual due date. So let's say on the 24th, you send an additional $100. You can actually have the entire $100 applied to the principal only. That's right. You can have the entire $100 applied strictly to the principal. And the principal is the original balance of that debt or the original balance of that line of credit or whatever it is. Now, let's say you made the total amount of $400 on the 23rd. What they're going to do is they're going to actually still split it between the original balance, the principal and the interest. But this strategy is you make the $300 payment on the due date and you pay the additional $100 on the 24th, and then that entire amount will actually go to the principal only. So this is another strategy to help you pay your debt down quicker. This is another strategy to help you mitigate paying more in interest. And this strategy can actually help you to pay your debts off quicker, because a lot of times people are looking for strategies on, hey, how can I pay my credit cards off? I want to think of a strategy where I'm not paying as much in interest and different things like that. So what you want to do is actually pay it a day or a couple days after. Now, just because you make this extra payment doesn't mean you don't have to make the payment next month either. That's another thing I want you to understand. And that is because the statement date has not been cut yet. That's why it's also important to understand what the statement date is, because let's say even on the 24th, you made an additional payment of $300. So that means for that month, you paid a total of $600. That doesn't mean that this $300 you paid on the 24th goes to the next month payment. No, because the statement date has not been cut yet. This is why it's important to understand statement dates. This is why it's important to understand due dates, because I've seen a lot of people get late payments because they made the $300 on the due date. They sent another $300 the second day or on the day after, and they're like, okay, I don't owe for the following month. Yes, you do, because they haven't cut a statement date for the next month yet. This additional $300 just went to the principal, which is still good for you because this cuts into the actual balance. But then on the following month, when the new statement date comes out, you will have to pay an additional $300 on the actual due date of that account. So hopefully this information was helpful for you. I know it may sound confusing a little bit. You may have to watch this video 3 times, and that's okay. But that's why I often say a short pencil or a marker is better than a long memory, because this type of information is going to be able to help you long term. One, just to have the access to this information, but then 2, it helps you to understand how credit works, how interest works, how debt works, how credit card companies work when it comes to their tricky systems and all this stuff. Because again, They want you to get caught up in that because every time you're late, you're going to pay more in interest. They can drag the debt out longer and all that stuff. So again, hopefully this information was helpful for you. What I want you guys to do me a favor, because I know a lot of people have a ton of questions on different topics and synopsis and, myths that they've heard about credit. What I want you to do, comment in the sections below and let me know what other subjects would you like to hear more of, because there's a ton of myths out there that have to do with credit. And I want to help to dispel that. Matter of fact, just to give you a quick one, I had someone reach out to me who just recently went through divorce, and they assumed that because the judge, handed out the divorce decree, that they were off the hook from paying the debt, even though both of them were on the contract. No, that's a credit myth. If you're on if both of you guys were co-borrowers on that debt, even though there's a divorce decree, it does not supersede the creditor's information. So this is the type of information that we need to know, because these are the things that get us in trouble from a credit score standpoint. So again, comment below. Let me know what other subjects and strategies and myths and all of that stuff you want me to talk about. Again, my name is Roundtree, and I'll see you at the top.